Welcome back to More Fun with Finance. This is Dr. William Elliott coming to you from my studio in beautiful Uptown Shaker Heights. Today's chapter is looking at a variety of sensitivity and scenario analyses, degree of operating leverage, soft and hard capital rationing, things of that nature. This is chapter 11 out of Ross, Westerfield, and Jordan. So let's get right to it. I'm going to shift over to the slides, get out of the way here, and we'll get started. So, already talked about these items. Oh, one thing I didn't mention was we'll also look at a variety of break-even analyses. This is really trying to get a more sensitive or a better picture of the project. One thing that I always remind my students of is that a point estimate is almost always wrong. And if you pick a range of some sort, you're more likely to be right more often than not. What we're really dealing with is this estimation risk right down here that they mention on this slide, and it's just the fact of the matter is that we're trying to predict the future, and it's a very difficult thing to do. So we want to do it with some sort of humility and understand that our estimates are probably off. So we're going to put some sort of analysis toward trying to eliminate that, or at least reduce the effect of that risk on our estimates. So one very common method is to look at scenario analysis. So we start usually with our base case, which is what we think is the most probable or most likely case, but we're also going to have a worst case and a best case on top of that. So we get three different estimates. Hopefully somewhere in between those is where the actual will fall. Now, if you look down here on this slide, I need to get out of the way for this one, but you'll notice that here's the base case, and we have 6,000 units that we expect to sell. We expect to sell them at $80 per unit. The variable cost is $60, and the fixed cost is $50,000 for the year. Now, lower bounds on each of these, in this case, are 5,500 units sold with a price of $75 instead of $80, variable costs of $58 per unit, and fixed costs of $45,000. The upper bounds on each of these variables is $6,500, $85 per unit, $62 variable costs, and $55,000 for fixed costs. Now, a couple of other things to point out here is that the cost of this project in this particular example is $200,000. It has a 5-year life and a cost of capital of 12%. We're also assuming no debt, so this is an entirely equity financed project, and the tax rate is 21%. Now, just a warning ahead of time here, when we go to our worst case scenario, we're not just going to pick the lower bounds here on all of these, because worst case, we're going to have the lowest number of units sold, the lowest price per unit, but we're also actually going to pick the highest variable cost. So we're going to pick out the variable cost that's over here, not the 58, but we're actually going to apply the 62. We're also going to pick the highest fixed cost. That would be our very worst case scenario. So recognize that that's when we see the next few slides as we go through this example, that's why those numbers flip around. This is just showing us the lowest level of each of the variables and the highest level of each of the variables as compared to the base case. All right, so let's look at that base case a little bit further, and let's get a cash flow here. This would be called the operating cash flow. And so we're starting off with sales in the amount of $480,000. We have variable costs. That would be our, let's see, we had $60. So that's $60 times 6,000 units is $360,000. We have fixed costs of $50,000. The other thing that we didn't mention, but you can easily compute from the cost of the project, is that we have a $200,000 cost and we're using straight line depreciation. It's got a 5-year life. So we just simply take 200,000 divided by 5 is going to give us $40,000 of depreciation each year. Now, remember from earlier chapters where we've talked about how to calculate cash flow. Cash flow is actual cash flow during the period that we're talking about. And that means that this depreciation is not a real cash flow. It's recognizing the use of the assets that we purchased to do this project, but we already paid for them up front. So when we calculate our operating cash flow, we're always going to be adding back the depreciation because it's a non-cash expense on the income statement. And then when we look at the EBIT, that's earnings before interest and taxes, we don't have any interest, so the next thing left is to simply calculate the tax rate based on 21%, and then we get a net income of 23.7. Now, we can start to calculate our operating cash flow from multiple places here. In the slide here, they show starting with EBIT. So they say, let's take our 30,000 EBIT, add back the depreciation, the 40,000, subtract from that the 6,300 that is our taxes. So that leaves us with a $63,700 cash flow for operations. Now, you don't have to start with the EBIT. You could actually start down here at net income. We've already accounted for taxes, so the only thing we have to do to net income is take the 23.7 and add back the $40,000 depreciation, that non-cash expense, and we're still going to get the exact same amount. Notice that these two amounts are identical. So it really doesn't matter where you start, just so long as you keep track of all of the cash flows. So in the base case here, we know that we have a 12% cost of capital, 5-year life, and they've calculated the annuity factor for us, and that turns out to be 3.60. And when we look at the net present value of that, we're going to subtract the cost of the project plus, and we could put parentheses around this just to make sure that it's clear that we're multiplying 63,700 by the 5-year annuity factor at 12%, that 3.6048. And we end up with a positive NPV of $29,624. So I'm going to show that to you, though, on the calculator. All right, so here we are on the financial calculator. We put in our 63,700, and that becomes our payment. We have no future value, so let's zero that out just to make sure that register is cleared. We're going to put in our 12% per year, and this is for 5 years, and we're going to compute a present value, and we get 229,624. I'll just get rid of that negative sign, and we subtract off our cost of the project, the 200,000, and voila, we get the 29,624 that is shown on the slide. So everything is copacetic there. Let's go back to the slide and get back into the slideshow. All right, so hopefully that makes sense. That's the base case. Go back and just double check the math with your own calculator and make sure that you understand that. Now, let's go on to the best and the worst cases. So in the worst case, as I noted before, you'll notice that in the worst case scenario, the units sold are 500 less than the base case. So we're at 5,500. The price that we receive is $75. The cost per unit is 62, and we have fixed costs of 55,000. And remember, back from the lower bounds, that's why I mentioned that the worst case is not just the lower bound. It's the lower bound on the units sold and the price per unit sold, but it's actually the upper bound on the variable cost and the fixed costs. We also have the best case, 6,500 units sold, so 500 above the base case. We get a price of $85 per unit. We have variable costs of only $58, and we have the fixed cost of 45,000. So we can do that calculation again. You'll notice that here's the base case, the numbers that we got there. We could actually also calculate a rate of return on this base case. This 17.8% is the rate of return. Let me just show you real briefly how to get that rate of return, since we have all of the numbers here already. So the one thing that was missing was that we didn't have the cost of the project in our present value. So if we set that up, always make sure that you get your signs right. We made the payments, that $63,700 positive. That's a payment we're receiving. The cost of the project needs to be a cash outflow, so that's why this is negative. I'm going to make that my present value. And now, instead of solving for present value, I'm going to solve for I. So I'm going to do CPT and I. And there's my 17.82. So if you were wondering about how to get that rate of return, this is the easy way to do that on the calculator. Here is the best case, $71,495 net income. When we add back the depreciation and get the operating cash flow, we end up with $111,495 of operating cash flow. Calculate the net present value, comes up to be $201,000, and of course that means that we're getting a much better rate of return on this. We're getting a 47.9% rate of return. Now, for the worst case, there's something very important. If you try to work through these numbers, you may wind up with a problem. And that relates to the fact that this is actually going to end up being a loss in terms of net income. It actually is a positive cash flow, but is a negative net income. Now, when we have, and that also means since we don't have any interest, it's also a negative EBIT, earnings before interest and taxes. So when we have a negative EBIT, we don't owe any taxes. And the other piece of this that you have to recognize is that any losses that we incur in a previous year, we can carry forward to a year when we have gains, and we can offset those gains with those losses from prior years. Well, the CFA Institute and the typical financial analyst is not going to handle it exactly that way because it just gets overly complicated. We don't know if we're going to have positive earnings in the next year. We don't know if we'll be able to fully take those losses against the positive earnings of the next year, and so forth and so on. So they make an assumption here. They make an assumption that we're actually going to receive a tax rebate. So the taxes, basically the assumption here is that we're going to get money back from the government because we had this loss. So if you actually try to calculate your net income and just say, oh, I don't owe any taxes. So if you actually did this calculation and just assumed zero taxes, you would end up with an EBIT of negative $23,500. And zero taxes means that your net income is a negative $23,500. So why is it that they're showing negative $18,565 as net income? And that's because they assume that money is coming back to us. Now, in reality, it won't come back to us until the next year, if we're lucky. But just to simplify the calculation. So to get this $18,565, take the $23,500 and multiply it by 1 minus the tax rate. In this case, the tax rate is 21%, so that's 0.79. times 23,500, and you will get that 18,565. And then the rest of the numbers follow from the net income. So the cash flow, we can either start at EBIT, or actually we should start at net income here because we've got that positive taxes in there. So we just add back our depreciation. Okay, so that's the only trick here on this worst case scenario. We end up getting a net present value of negative 122,732 and an IRR of negative 17.7%. So in the worst case scenario, we would actually not take the project. But that doesn't mean we won't take the project overall. We're just trying to get some sense of the possible outcomes. All right. Now here we're looking at some sensitivity analysis. Now, the previous slide was scenario analysis. That's where we move and change a variety of variables and come up with a best, base, and worst case scenario. Here we're just going to change one single variable at a time, and we're going to see how sensitive the outcome is to a change in each of these variables. So in this first case, we're just going to look at changing the number of units sold. So we're going to look at the base case, the worst case, and the best case, and everything else stays the same. The prices stay at the base case and so on. The variable costs, the fixed costs stay at the base case. And what we'll find here is that our net present value varies from 1,147 all the way up to 58,000. But they're all positive, which is good, certainly. We hope that that's the case, but that gives us some confidence that, assuming that the other variables remain the same, that if unit sales drop down to what we think is the worst possible level, we'll still have a positive NPV project. Now, here's another sensitivity analysis, just simply looking at changing the fixed cost component. So here we look at the base, the worst, and the best case. And we see that the net present value here varies between 15,000 and 43,000. Not as big a range, but all, again, positive NPVs and IRRs that are above our cost of capital. Remember, our cost of capital is that 12%. So all of these IRRs are above that, and all of these are above that. So again, that tells us that it gives us some confidence that our project will likely end up with a positive NPV and should be a project that we would be willing to take. Now, you can plot this on a graph. What they've done here is they've plotted versus unit sales here on the x-axis, and NPV is over here on the y-axis. And the steeper the slope of this line, the more sensitive it is to a change in unit sales. So we like to see a slope, more like this, where it's very little sensitivity to changes in unit sales. But the reality is that this is what we get. But it's just another way of visualizing this. All right, simulation analysis is yet another type of evaluation that we undertake in order to make sure that we're not missing something. Usually this takes the form of what's known as a Monte Carlo simulation. So just in short, what a Monte Carlo simulation does is it says, well, let's take all of the variables that we're estimating with some error, and let's what we call parameterize them. That's just a fancy way of saying, let's look at what the high is, what the low is, and how they might move in between that. Are they normally distributed? Is it a uniform distribution? What's it look like? We're going to do that for the fixed costs, for the variable costs, for the price per unit sold, for the number of units. We're going to parameterize all four of those items. And then we're going to run this Monte Carlo simulation. So the way the simulation works is that we might, say, run it for 10,000 times. So the first time that we run it, we're going to go draw the number of units sold randomly out of our distribution. That's the number we plug in. Then we get the price per unit, plug that number in. We draw out of the cost, variable cost per unit, plug that in. And then finally, we draw the fixed cost and plug that in. Run the calculation, calculate our MPV, calculate our IRR, and then we do that 9,999 more times. So you get a pretty good estimate of where things are going to be. Now, this is difficult to do with just a spreadsheet, but there are some handy-dandy plugins. One of them is a product by Oracle, and that is this Crystal Ball plugin. There's another product called At Risk. That is the at symbol. It's written like this, at risk. Oops, you can't see that, can you? Well, let me try again over here. At risk. So that product is also another good, both of these products are quite good at this. This Crystal Ball is a little less expensive, and you can go to the website and look at it. You can actually download a trial copy of it. But this is the sort of look that you get on your spreadsheet. You're able, this is what we call the, when we parameterize it, we put a distribution around it. So that's what this is actually a normal distribution. And we can do that with all of the variables that we are estimating with some level of risk. So that's another, another method to make sure that when we do present this to our managers or to our board, that we're presenting them with a range. And with something like Crystal Ball or At Risk, we can actually say to our manager, hey, with 95% confidence, the values for the MPV should fall between these two ranges or these two levels. So it's a very handy method. All right, so now on to break-even analysis. So we're going to look at what is the break-even analysis with regard to variable costs and fixed costs. We're going to look at accounting break-even. We're going to look at cash flow break-even, things of that nature. So first off, we have our variable costs. They're positively related to the quantity of output. And so the total variable cost is the quantity produced times the variable cost per unit. Change this back to a highlight. And so if, for instance, we were to produce 1,000 units and the variable cost was $2 per unit, total variable cost would be $2,000. Now, we want to add to that fixed costs so that we can get total costs. If fixed costs are they are literally fixed, right? Within a year, you can think of it as maybe you're leasing a building. Well, whether you produce one widget or 8,000 or 10,000 or 100,000 widgets, the lease on the building is the same. So that's an example of a fixed cost. And in this case, we're told that the fixed costs in this particular example are $8,000 per year. So there's our 8,000. We have variable costs of $3. And suppose that we produce 6,000 units. So that would be $3 times the 6,000 or $18,000 plus the 8,000 fixed costs gives us 26,000 in total costs. And you can see down here on this little table, I need to get out of your way again here. You can see on this table how that changes with the amount produced. So we go from 0 to 1,000 to 5,000 to 10,000. Notice that the variable costs go up linearly. And again, we can plot this and kind of get a better sense of what's going on. Obviously, we see here that fixed costs is this green line, and we add on top of that the variable costs. As the number of units produced goes up, our total costs go up as well. And it's a linear relation. All right, so what's the difference between average cost and marginal cost? Well, in this example, we're going to look at that issue. Here we have Bloom Corporation is a manufacturer of pencils, and the pencils cost them 55 cents to produce each pencil. They currently have a plant that costs $5,000 a month to maintain. And so on a yearly basis, that would be $60,000 of fixed costs. And they also produce out of that plant 100,000 pencils per year. So when we look at the total costs, we've got variable costs here of 55 cents times 100,000 pencils plus the 60,000. So we have a total cost of 115,000. Our average cost is only $1.15. Or I guess I should just say it is $1.15. Now, here's where average versus marginal becomes important. Bloom Corporation gets an order for an additional 5,000 pencils. They actually have a little bit of excess capacity in this plant, so they are able to produce those extra 5,000 pencils without adding onto the plant or increasing the fixed costs. So the fixed costs are going to remain at 60,000. So the question becomes, at what price should they sell these extra 5,000 pencils? What is the lowest price they could sell them for? In this particular example, they say, well, suppose that we were able to sell these pencils for 75 cents. Well, that's below our costs here for the original 100,000. So is that really right? But yeah, the answer is yeah, it is. As long as those original 100,000 pencils get sold for more than $1.15, then we could produce another 5,000 and sell them to another buyer for only 75 cents a piece. And we still make 20 cents per pencil on that. So that's the difference between average and marginal. And by the way, just in terms of the words here, marginal and incremental are synonyms. So whether we're talking marginal or incremental, we're talking about the same thing. All right, on to break even for accounting. Now, what we're trying to do is we're trying to set the net income equal to 0. So here in this particular example, we are producing computer disks, and these disks are 1 petabyte. Anybody know what a petabyte is? You've all heard of kilobytes and megabytes and gigabytes and terabytes. Well, the next thing up is a petabyte. So a petabyte is actually 1,000 terabytes. So in this case, we're able to retail these 1 petabyte disks for $5. And we can buy them from a wholesaler for $3 each. So we're making $2 on each disk. We have accounting expenses of $600 in fixed costs and $300 of depreciation. How many disks do we have to sell in order to break even? Now, remember, that's not our goal, but we do want to know what's the minimum. What's that, where do we start making a profit? Well, first off, we look at what we're contributing towards covering those fixed costs and that depreciation expense. For every disk we sell, we contribute $2 to covering that $900 of fixed costs and depreciation. So as a result, that means that we're just taking that $900 divided by the contribution per disk, and that tells us that if we sell 450 disks, that we will have exactly 0 net income. So anything above 450 was positive net income. So just to prove that out, they show an income statement here with 450. That's $2,250 in sales, $1,350 in variable costs. The fixed costs are $600. The depreciation is $300. EBIT is 0. We're assuming no interest. It means taxes are also 0. And we have 0 net income. So that's an accounting break-even analysis. And again, graphically, they show you this little graph here just to try to give you a visual representation of it. The line here on the bottom is our revenue, and the line on the top is our cost. And so we start with 900 because that's our fixed cost plus our depreciation, and it has a less slope, so eventually they cross, and right there where they cross is our break-even point. After that point, as the number of sales goes up to 500, 600, 700, now the difference here is our profit, is our net income. All right, and what we can do is we can actually plug this into a formula and get an easier way to calculate this. So if we assume that this sales minus variable costs, and that would be the total sales and the total variable costs, that's what we contribute to deferring our or reducing our fixed costs and our depreciation, that when those are exactly equal to the fixed costs and the depreciation, that's when we have a net income of zero. Rearranging some of this, we can actually plug in for sales. We have the price per unit times the units sold. Variable costs, we have the variable cost per unit times the number of units sold. And then over here, this remains fixed costs and depreciation. And basically, a little bit of algebra, we solve for Q, or we isolate Q over on the left-hand side. And so we configure the quantity that gives us a accounting break even is the fixed cost plus the depreciation divided by the price per unit minus the variable cost per unit. Accounting break even is often calculated, and it's very simple to understand. As the slide notes here, it's similar to looking at payback. It's very understandable, and but it doesn't always tell us everything we need to know. Managers are often concerned about the contribution a project will make to the total accounting earnings of the firm, and the project that just breaks even on an accounting basis loses money in a financial and opportunity cost sense. In other words, it's not a positive NPV project. Okay, so now we're going to look at the operating cash flow for an accounting break-even situation. In this example, we have Westway Sailboat Corporation. They're considering building a new model of sailboat. They expect to sell that at $40,000 per boat. They have variable costs of $20,000, fixed costs of $500,000 per year. Total cost of the project is $3.5 million. Going to be depreciated straight line to zero over a 5-year life. No salvage value, no working capital, and the required rate of return is 20%. They project that they should be able to sell over the 5 years 425 boats. That's 85 boats per year. And for the moment, we're going to ignore taxes. The question is, should we launch the project? All right, so what is the operating cash flow for 85 boats per year? Well, let's start with EBIT, add back depreciation. And since our taxes, we're ignoring taxes, that would be zero. So here is EBIT. It's sales minus variable costs, minus fixed costs, minus depreciation. But we add back the depreciation. So that's 85 units sold at $40,000 with a $20,000 variable cost. Subtract off the fixed costs. And since we're subtracting and adding depreciation, that just goes away. That means that we have an operating cash flow here of $1.2 million per year. At 20%, they give us the 5-year annuity factor. That's 2.99. And when we multiply 1.2 million by that and then subtract off the original cost of the project, $3.5 million, we end up with a positive NPV of $88,735. So we would say that we would take the project in this case. Now, if you wanted to use your calculator to calculate that value, that present value from the 1.2 million per year for 5 years, let me show you just quickly how to do that. All right, so I'm going to clear my work, and we're going to start off with 1.2 million as our payment. We have 5 years as our time period. 20% is our discount rate. And I'm going to zero out the future value just to make sure it's clear. Compute my present value, and I get $3.588734 million. So we subtract off our 3.5 million cost, and that gives us our $88,734. So that's how you would do it on the calculator. All right. Now, what is the operating cash flow if we have a zero net income? In other words, if we have an accounting break-even point. Well, it turns out that the operating cash flow when net income is zero is simply the depreciation. Yeah, just the depreciation. Right? So think about this. If we're taking net income and adding back depreciation to get operating cash flow, and net income is zero, then operating cash flow and depreciation are the same thing at an accounting break-even point. So it's very easy to calculate the break-even number of boats. Operating cash flow would be $700,000 per year, and that means that we would actually produce 60 boats to have our net income equal to exactly zero. I'll leave that for you to just walk through with the calculator. I'd really recommend that you do that, though. It's good practice for you. It's helpful to look at sales volume and operating cash flow and see what the relation between those two are. So first off, let's get our operating cash flow. We can see that our operating cash flow, when we don't have any taxes, remember that's key, is EBIT plus depreciation. What's EBIT? Well, EBIT is the price per unit minus the variable cost per unit times the quantity minus fixed costs minus depreciation. So when we do a little bit of algebra there, we get P minus V times Q minus the fixed costs. The D's just cancel out. Plugging in the actual numbers for our Westway sailboat project, we have $40 is 40,000. These are in thousands. Is the expected sale price. 20,000 is the variable costs. The quantity we'll leave just as a variable as Q, minus the fixed costs of 500,000. And so we can rewrite that a little bit, and this is the equation for a line, actually. Here's the intercept, the 500, and here is the slope. So if we were to plot that out, this is what we would get. And so what we see here is that we can plot a variety of break-even points here. So on a cash flow basis, the break-even point is actually only 25 boats sold, and we'll break even on cash flow. We don't want to just break even on cash flow because that is not a profitable project. The accounting break-even point, as we calculated earlier, is shown right up here at 60. And the financial break-even point is shown right here. That is the point at which we actually have a positive NPV project. That's a very important one. In fact, this financial break-even point is really the only one we need to care about because anything below that, we're losing money. Now, certainly it's nice to know how much money we're losing, but nevertheless, anything below 84 boats per year, we're losing money. We projected that we're going to sell 85 boats per year. That doesn't leave us much room. That's why that NPV was only $88,000 on a $3.5 million project. That tells us we're really close to the borderline. So if I was analyzing this project and I had to tell my boss, yay or nay, I would say, let me do some sensitivity analysis, let me do some scenario analysis, and I'll give you a range. Because right now, with the projection of 85 boats per year, that's too close. That's too close to call. It's a lot of risk in a project like that. Now, if we were projecting 100 boats or 110 boats or something of that order, then I'd feel much more comfortable about the project. But this particular project, this example, it's really dicey. Cash flow accounting and financial break-even points, we've really, we've looked at them here on the graph, and I think that's the key to it all. This takes you through some of the algebra behind it, and I don't think that's particularly helpful. The one thing I will point out here, though, is that what we can do is we can just change this number here from 0 for that cash flow break-even to depreciation, the level of depreciation for the accounting break-even to to get our various break-even points. Now, here, using that same formula, what we're trying to do is we're looking at what operating cash flow do we need to generate annually in order to pay us back exactly $3.5 million. That's what they're doing right here. They're calculating that operating cash flow. It needs to be at least $1.17 million in order to give us a 0 NPV. Anything above that will be a positive NPV. And so that actually turns out it's not exactly 84 boats like we saw back here on the graph. It actually turns out to be 83 and a half boats per year. So it's better, but we're only 1.5 boats above that with our sales forecast. So again, I'm still very skeptical that this is a good project. I'd want to know a lot more about that sales forecast. All right. This is just a summary of these break-even measures. And again, notice this numerator in particular. We can look at that operating cash flow. We can set it to 0, which will give us a cash flow break-even. We can set it to the depreciation, which will give us an accounting break-even. Or we can set it to the operating cash flow that will generate exactly $3.5 million in present value over the next 5 years. And that will give us our financial break-even volume. So this formula right here is a really handy formula and very helpful. It can give us all 3 of those break-even points. And I'm going to skip over these slides here because they're just reiterating what I just said. And now we're going to get into operating leverage. Now, operating leverage is an interesting concept and a very important one to understand when it comes to looking at any particular project. You all are probably familiar with financial leverage, and you may not know it by that name, but if you own a house, you have financial leverage. What do I mean by that? Well, what I mean is that let's say you buy a $500,000 house and you put 20% down, so that's $100,000, but you're going to borrow the other $400,000 to buy the house. That right there is financial leverage. You're borrowing $400,000. Now the bank is going to want their $400,000 back plus interest. But that's it. They don't get anything more or anything less than that. So if the value of the house, let's say the value of the house goes up to $550,000, it goes up by 10%. The bank just wants their $400,000 back. But you get to keep that extra $50,000. So when we think about your return on your invested capital, you've only invested $100,000 on that house. And if the house goes up by 10%, your return is 50% because you get $50,000 on top of the $100,000 that you originally invested. So you're getting 5 times. It's magnifying your return by 5. Now, the reverse happens. If the price drops by 10%, you lose 50% of your original investment. So if you were to sell it, you'd only walk away with $50,000 instead of the 100,000 that you originally bought, because the bank still wants their 400,000 back. That's how financial leverage works. The greater amount that you borrow, the more the financial leverage and the more magnification of your invested dollar return. But that becomes risky, right? That's why the typical house mortgage requires a 20% down payment, because the bank isn't in the business of, losing money. And so they want to make sure that you've got enough, quote unquote, skin in the game, that you're going to be careful and make sure that you buy a house that will at least stay the same value, if not appreciate slightly, hopefully not depreciate too much, unless we run into situations like the global financial crisis back in 2008, where housing prices did drop precipitously. And it woke up a lot of people that, these things are not a sure thing. It's not an investment that is without risk. Now, back to operating leverage. Operating leverage works in a similar way in that the higher the operating leverage, the greater the risk. Now, operating leverage has to do not with borrowing money or going into debt to purchase something, but it has to do with the amount of fixed costs versus total costs. So if fixed costs are very high, that means that a small drop in sales could cause us to lose money, have a negative net income. If fixed costs are very low, then the largest fraction of our costs are variable costs. And as a result, if our volume drops off, our variable costs go down, but our fixed costs are relatively minor, so we're able to easily pay that. So the higher the operating leverage, in other words, the higher the fixed cost component of total costs, the riskier is our business. All right, so it's a very important thing to consider, especially in light of operating leverage and financial leverage for a company. Both add to the riskiness of that company. And if we have high operating leverage, ideally we'd like to have low financial leverage. But let me tell you the really crazy part about this. If we have high financial leverage, or rather, if we have high operating leverage, that probably means that we have a lot of real estate, a lot of buildings, a lot of very expensive, big equipment on which to borrow that money. It becomes the collateral for those loans. So when we have high operating leverage, we have the ability to borrow a fair amount of money on that. And that lowers the amount that we need to raise in the equity capital markets. And that's a problem, right? Because high financial leverage coupled with high operating leverages makes our business much riskier. So it's not a given that we're always going to borrow that amount, but it's very common where we have capital-intensive businesses, i.e. high operating leverage. We also have high degrees of financial leverage. Now, if you're in a business that's a service business, most of your costs are variable, right? It's human capital, and that can go up and down with the level of the business. But if you're in a manufacturing business, usually those are very capital intensive, big companies or big plants, big equipment. Think about integrated circuits. Think about a company like Intel or NVIDIA. It's very costly to build those factories. And as a result, they have to keep up the volume. If they drop just a little bit, it's going to flip their net income from positive to negative very quickly. Sorry, I let the slides fall back here. And anyway, that's operating leverage in a nutshell. All right, so how do we actually measure this operating leverage? Well, we use a measure called the degree of operating leverage. Effectively, this degree of operating leverage is the percentage change in operating cash flow divided by the percentage change in Q. And so what that means is that let's think about the Westway sailboat project. we have a queue. Let's say we start with a queue of 50 boats. So we're selling 50 boats, producing 50 boats a year. What happens if we add one boat to that? We go from 50 to 51 boats. So here we have the percentage change in queue is 51 minus 50 divided by 50, or 0.02 or 2%. So that's our change in queue. Let me get out of the way here so you can see the rest of this. Now, what's our change in the operating cash flow? Well, the change in the operating cash flow is it goes from 500 to 520. That's that contribution there. And so the 520 minus 500 divided by 500 gives us a 4% or 0.04 change in operating cash flow. So 0.04 divided by 0.02 gives us a degree of operating leverage equal to 2. In other words, for every 1% change in quantity, we get a 2% change in operating cash flows. Now, if we look at this and we say, well, gee, suppose instead we're at 75 boats, we're going to find that our degree of operating leverage changes. And you'll notice that it actually will go down as the number of boats produced goes up. And that's because that fixed cost component is being spread across more boats. So it's a smaller part of the total cost per boat. So in the case of 75 boats, we do the same sort of calculation. We're going to end up with a degree of operating leverage of only 1.5 instead of the 2. Again, if we went up to 100, you would see that degree of operating leverage drop even further. This is always a good thing. The higher the number of units of output that we have, the lower our degree of operating leverage, the lower the level of our risk. All right, so here in an example of looking at operating leverage, and we're going to bring in the accounting break even and so forth, we have Sasha Corporation. They sell gourmet dog food at $1.20 per can. Variable costs are 80 cents per can. We have fixed costs of $360,000 per year and depreciation of $60,000 per year. So the first thing we want to do is to get the accounting break even level. We're going to ignore our taxes. So to get accounting break even, that is our fixed costs plus our depreciation divided by P minus V. That is the $1.20 minus the 80 cents. So that gives us our contribution. So the accounting break even is 1.05 million cans of dog food sold. Now, the question is what is our degree of operating leverage at this point for each additional change in quantity sold? How much will our cash flow go up by? Well, we know that at accounting break even, our operating cash flow is exactly equal to the depreciation. In this case, that's $60,000. We know that our fixed costs are $360,000. So to calculate our degree of operating leverage, it's 1 plus 360 over 60, and that equals 7. So that means that for a 10% increase in the number of cans sold, we have a whopping 70% increase in the operating cash flow. So clearly we want to try to do that. It would be worth spending some money in order to get that 10% increase because of the huge change in operating cash flow. I'll just skip over this. I'll let you walk through that yourself. You can stop the video here and work through that math if you'd like. Then last subject in this chapter is capital rationing. We have both a soft capital rationing as well as hard capital rationing. The only difference is that in a soft capital rationing, we might have some ability to manipulate that. You can think of this as like a division of a corporation, large corporation, and you're allocated a particular amount of capital to invest for the upcoming years. And there may be some chance that if you can show upper management a really, really great positive NPV project, that they may give you a little bit extra capital in order to do that project. That's the soft version of it. But originally you have some sort of budget. you try to work within that budget. But if you've got a fantastic project, you may be able to work around that issue. You might be able to get a larger allocation. Now, hard capital rationing is more likely in the case where maybe a company is in distress or has already maxed out its ability to raise additional capital or to borrow money, or its banker says, look, we're stopping you here. You've got enough debt right now. So even if you have really good positive NPV projects, you may not be able to do them if there is something like this hard capital rationing where you just can't get the capital to take on the new project. That's it for Chapter 11. I hope that you've enjoyed it, and I will see you shortly for Chapter 12. Bye-bye.